Today is the day. We are going live this afternoon. So you can join us at retirementloop.ca/webinar. And if you're late, don't worry. You can go to the same link and you're going to get the replay. But for now, we are going to listen to the end of the webinar I did with Adam Bornn from Parallel Wealth. Fellow investors, bonjour. This is Mike Leroux, founder of Dividend Stocks Rocks and passionate investor. You're listening to the Dividend Guy blog podcast where I and my co-host Véronique will help you invest with more conviction so you can enjoy your retirement. Dividend Growth Investor, bonjour, Mike Leroux here, listening to the Dividend Guy podcast. I am with Vero for the next part. So you're in for a treat, guys. I mean, 2 podcasts, 1 webinar this afternoon. I don't even know if you'll have enough time to cover everything in a single day. How are you doing, Vero?
I'm doing good, Mike, and it was such an amazing discussion with Adam. So today is part 2 of that webinar you did with him. What I enjoyed the most from Adam was his straightforward way of explaining concepts and making things fun and easy to understand, which actually reminds me a lot of you, Mike. So what's the most important insight that you got from Adam?
It's kind of funny because we didn't we prepared the questions and the major themes, but I did not know his answers. And most of his answers were actually 100% aligned with mine. So it's kind of interesting to see that we have a very almost identical ways to approach retirement planning, to approach investment, and thinking that there are plenty of strategies that work, but the one that works for you that you can stick for decades is the most important. Among the lessons, actually, it's one that we are going to listen today, and that is a major mistake that I've seen so many retirees have, is they do not have a clear income plan. And by a clear income plans, I mean, yes, you have your projection. You know that you're good. You know that you can withdraw whatever, like $40,000, $50,000, $60,000 from your portfolio. But then you have absolutely no clue how you're going to set up the mechanics behind it, where you're going to get the money, from which account. And once you have established this, it's okay, now I know I need to withdraw $20,000 from my RRSP. So do I generate income out of that? Do I generate dividends? Do I sell shares? Do I make a combination of that? All of this should be part of your income plan. So we had a great discussion about this with Adam. He brought up some interesting tips as well to structure for most people. And this is what's difficult. And I think that he did it so well, is each situation is different. But then again, you need kind of a framework to at least know the steps to identify how you're going to build your clear income plan. And this is what we got in this second part of this webinar.
So in this part 2, we will end the 5 lessons, and also you will hear Adam's answer to live questions that happened when we did the webinar. And this is precisely what we will be doing today as well during our webinar at 1 p.m. So if you listen early, you can subscribe now at retirementloop.ca/webinar. If you missed it, join our Retirement Loop waitlist at retirementloop.ca to get more retirement tips, right, Mike?
Yeah, and what is interesting is I don't know if it was a mistake or it was a good move on my part, but for those who already registered to this webinar, I usually don't do this, but I asked every single one person that registered if they had any pressing questions. And then I had to redo my entire webinar presentation to make sure that I included those answers. So it was a lot more work for me, but I think it's going to be filled with even more answers to your questions. I think you're going to love it. As you said, if you're late for the party, don't worry, you're going to receive the webinar replay. Also, if you join the newsletter, you're going to receive our 20 income product guide. So I've reviewed 20 different types of investments that generate income at retirement. I classified them, I rated them with a star rating, so you can actually know which of those income products are the best for you. And finally, in the next 2 weeks, we are reopening the doors to Retirement Loop. We opened the doors once in December of 2024. They were closed beginning of January of 25, so at the beginning of the year. That community just exploded. We had almost 500 retirees that logged in there, and now we're providing a lot more content to those guys. We help them build a retirement plan, doing the Loopers show to answer those questions. And so we had to close the doors, making sure that we took care of our members the right way. And now we are good to reopen for a new cohort. We even have a retirement coach and that will be able to review your projection to help you find some optimization out of there and get even more information. So just make sure that you register to the free newsletter at retirementloop.ca, or that you go to watch the webinar replay at retirementloop.ca/webinar.
And by the way, Mike, I have to add something. Like what I've noticed from Retirement Loop when we started this community, it was the fact that people are like hungry for answers about retirement. They really want answers. They are a bit anxious. They are hungry about that. And so we had to adjust to them, and so we did. And so I'm just telling you guys, you will get a lot of answers there. So again, retirementloop.ca to join the waitlist and the newsletter, and retirementloop.ca/webinar for the live session. So if you enjoy what we do at any time, you can hit pause and the subscribe button underneath our podcast logo. Now, let's hear more from Adam Bornn.
How do we solve that and not have a clear income plan, or how do we build one?
Yeah, and that's what I would say. Like, you want to get a plan done. Again, whether you hire a planner or whatever it is, but have a plan put together 3 to 5 years before you retire. Because then you know when you retire in 3 years from now, where your money needs to come from. And it allows you to start building like what a lot of people would call the cash wedge. So what you want to do is have, ideally, we like 3 years, some like 2, some like 5. I'll settle on 3 for now for the basis of our conversation. But whatever your plan shows, make sure you have 3 years of that cash flow ready to go. So as an example, if the plan shows, at retirement, your RSP converts to a RIF and you need to take out $50,000 a year for the next 10 years out of your RIF, make sure $150,000 of it is not tied to the stock market. Because again, if you retired on April 1st of this year and we're starting to draw down and you didn't create that cash wedge, it leaves you in a really bad position to the point where you don't travel, you cancel stuff, you're selling at a loss. So start building up that cash wedge, and you always want to have 3 years. Now, if you build up 3 years of cash wedge, hit retirement, and we're at a peak, like maybe you retired mid last year, it's like, well, markets are at maybe a high or close to high. Hard to always tell, no one has a crystal ball, but you can take your income out of there, sell stock, but keep that cash wedge going. Then when the market drops like it is now, you have that cash wedge that you can start depleting. As markets come back up, replenish your cash wedge. So again, if you're working with an investment advisor or doing it yourself, doesn't matter. Have a strategy behind it. And we see a lot of, I don't know how many DIY investors you guys have within here, but
I would say most of them.
Most, okay, yeah. And it's one of the challenges, that's what I figured. It's one of the challenges of DIY investing. It's DIY investing, you kind of learn like, how do I buy, how do I analyze stocks, and, watch earnings reports and all that kind of stuff. When you hit retirement, it's like, now I also need to figure out how to build my cash wedge and what tools to use for that and the cadence of it. So it's like, there is that education you need to kind of put yourself through as a DIY investor in retirement. And I think anyone can do it, but it does take extra effort. So look forward 3 years. Like, what is your cash wedge requirement for each different account, and build it out. So in the RIF, if you need that $50,000, yeah, maybe it's putting 150 in a high interest savings account, or if you can buy some direct bonds or whatever it is. Like, there's different GIC, ladder GIC. Like, there's different tools, and there's not one better than the other. So make sure it's not tied to the market, so that when you need the cash flow, when you want to travel and hit your bucket list, you're able to do it.
So the point is to find an investment vehicle that is accessible, does not really fluctuate, and pay some kind of like interest or yield, but not too much, just to make sure that it is like more safe actually than it is like producing income. I have a question about this though. So you're saying 3 years, like let's say your retirement budget is like $50,000, so that 3 years would be 150. Would you be tempted to count like any interest income or dividend income produced by your portfolio to maybe lower that amount of cash? Or you just go, no, I want 3 years flat, and then if I generate like $30,000 in interest and income and dividend and everything else without selling shares, that's still good for me. It's just going to be part of the budget, but I want to remain with the cash wedge of like 3 years besides this.
No, calculate in the dividend. So as an example, like an investment firm that I use personally and a lot of our clients use as part of our retirement income program, BCB. So they buy blue chip dividend paying stocks. So they own 40 to 50 stocks. They buy individual bonds as well. So when we build a plan, we say, look, Mike needs 50,000 out of his RIF. They're going to look at your portfolio and say, well, based on the structure and stuff, we're going to get about 25,000 a year in dividends out of there. So what they buy direct bonds, which did a great resource for our clients. So they'll buy a $25,000 bond that matures next year, year after, the year after that. So of your 50,000 cash flow, 25 is dividends, 25 is bond, right? So cash dividends coming in, especially big blue chip companies, like those dividends aren't turning off. And if they
Mhm.
are, we have bigger problems than that. So, that cash flow is coming in 25,000. They can sell the bond. There's another 25. So you're hitting your cash flow needs. So really they're only putting 75 of the 150 kind of aside. The rest is just coming in naturally. So yeah, that's where you need to look at your portfolio, look at the natural cash flow. Just be cautious. Like if you're more of this like high interest stuff, or like if it's not like rock solid, like blue chip, they've increased their dividends for the last 500 years straight kind of idea. Like be cautious on that. You want to make sure you have that cash flow there, but definitely have some natural cash flow coming in. That can be part of the cash wedge.
What I like to say about that yield to have kind of like a gauge or a red flag is anything that is above 4 or 5%, probably not necessarily take it fully for granted. Yes, there are exceptions, but it
Mhm.
is unlikely that it is will be sustainable throughout your entire retirement plan. If you have like something paying like high single digit to now we have like, and I have a question for you later on about like covered call ETFs and those super high yield in the
Mhm.
double digit, but we're going to tackle that later on. But for now, if you're planning your income and you're thinking, oh, my portfolio generates like 15% yield, that's not going to be sustainable. Like in
Cut that in
financial
half.
planning, even the 4% withdrawal rules, that is like kind of like a rule of thumb, is already saying, you know what, if you go into a very bad market, that's you're probably going to outlive your portfolio. So even
Yeah.
at 4% is not 100% sure. So at 15, I feel very confident to saying that is 100% not sure. At one point or another, your budget is going to drop a little bit. When we just, it's kind of funny because we have not discussed this, but this is exactly my perception of like the cash wedge. Having 3 years, mostly because a 3 years period will cover most bear markets in
Mhm.
general, because in general it takes about 2 years to fully recover. You have a solid protection against financial crisis such as what happened in 2008, even though it took more 4 to 5 years to recover. But at least you don't have to sell at the bottom. You will be selling as the market recovers. It's not too bad. And I also include like the income generated by the portfolio. So we have, without knowing, we have a very similar angle on that. One last point, when we discussed this meeting, you were talking about like the bucket strategy, like the short-term cash, the midterm fixed income, and the long-term growth. We talked with the first bucket, but how do you address the bucket number two and bucket number three in terms of like some tips for people to
Yeah,
manage?
for sure. I think a lot of people walk into retirement, especially DIYers, with like 100% equity, right?
Mhm.
So it's think about when you think about that cash wedge again, like what are we putting aside that's like safe, not tied to the market at all? And then you might want to think about something that does generate a bit more cash flow, right? Like whether your opinion on dividends are great or not, I personally I see it firsthand with thousands of Canadians on an annual basis where if they can have a little bit of dividends coming in through good quality, I'm not talking the high yield. That's a separate conversation. We can talk about that. Happy to do that. But I'm saying like your Canadian banks and energy and FedEx and Microsoft and Johnson Johnson, these quality companies that have a history of increased dividends, increased earnings, good cash flow, etc. Those types of investments can be really nice and a bit of a steady eddy in retirement because it's producing that nice cash flow. They don't fluctuate as much with the markets as like a Shopify, Tesla, these other more
Mhm.
speculative stocks that are great companies, but just have more swings in their stock price. So I don't think like a lot of people when they hit retirement, it's like, well, I need a 60-40 or 70-30, or they think about it that way. I don't think about that at all for clients. And that's a conversation we have with our clients. Don't worry about like your asset mix as far as that goes. Think about your cash flow. So if your cash flow again is 50 grand, well, put 150 aside and literally everything else could be fully invested. So it depends. If you have 5 million, it's a large percent. If you only have 300 grand, it's 50%. But so it's not really 60, 40, 70, 30, whatever that mix is. It's more cash. And what are you comfortable with the rest, right? Risk
Mhm.
tolerance and risk capacity. Those are two things you want to look at with the rest of that money. So does that answer your question?
Yeah, it did. So what I find interesting, just to making sure that like I get that right, if you have a portfolio that is mostly invested in stocks, as long as you have your cash wedge, that is perfectly fine. And then the second level would be, well, I don't feel good anymore when the market is down 10%. And my portfolio is actually down roughly the same 10% because it's fully invested. So most likely you're going to be between -8 and -12 as the market is down 10.
Yeah.
So at this point, you don't feel good about it. This is the time you review your asset allocation and you think about maybe a little bit more bonds, something more towards fixed income to smoother those
Yeah.
volatile market, right?
Yeah. Yeah, if you look at like a typical pension plan, like BCV, the firm that I use, so some of my money, equity. I don't have bonds right now because I'm many years from retirement. But when I hit, I will have bonds, and our clients have bonds in their portfolio. They also have an alternative pool, so they do like private equity, private debt, real estate, mortgages, that kind of stuff. So stuff that's not tied to traditional markets, it yields 9-10%. But again, it's that middle point, right? So bonds, bonds were good during COVID. They come back down. Our clients are getting 5-6%, let's call it, on a decent grade corporate bond. And this alternative pool, and I think BTB for our average clients is about 10 to 20% holdings. But if you look at like a traditional, like the Ontario's teachers pension plan and big pension plans, your alternative asset mix will typically be close to 50, if not more percent of the pool. So yes, they do
Oh,
the traditional investments, but you drive downtown Toronto, Vancouver, Montreal, wherever you are, and you see these big towers. It's like, who owns all these towers? A lot of them are pension plans, insurance companies and pension plans. Like they own a lot of these towers, and it's they get their clip on there on the leases, and they're happy with that. Very
yeah.
stable investments, and so it's much harder for the individual investor to get into this alternative space in a risk adjusted way, right? Because typically there's a 2,500 BTV. Some of the pools they use is $10 million investment required, right? But because they're pooling it and they use big firms, they're able to do that. So for the average investor, it is tough. But again, that is a space you want to maybe start doing some research on and finding a good mix for yourself, because it does keep your money working for you, and typically a good rate of return overall, risk adjusted, but it doesn't kind of swing with the market.
Yeah, that's what I call patient capital, because you're
Yeah.
not going to get your pet capital right away. Those infrastructure are for like 50 years, 100 years of holding period. So you don't do it as an individual, but as a pension plan. That totally makes sense.
Yeah, just be careful with that stuff because a lot of it, high fees, you're locked in for a certain period of time. A lot of more BC, we have mortgage investment corporations mix. They're very popular. A lot have been locked up. Like I had some family that were in one, got locked up for great, they were getting 11% every year. Then it locked up for 2 years and they got like 82 cents back on the dollar. So at the end of the day, they were there for 10 years and got nothing out of it. So they are different types. Like do your due diligence because they're not all the same.
Yeah, and there's a lot of promises out there, so you have to be
Yeah.
careful.
And there are like I saw a comment come up through Roland here. I know we're getting comments later, but like I don't know if there's ETFs out there on these stuff. I assume there is. It's not my space. Like we do more planning. We don't get into product and investments, and we leave that to other firms to do. So I don't have that answer. Maybe someone within this group does, but if there's not, I'd assume there is going to be some ETFs coming out sooner than later.
I know we're gonna answer that question right away, so we can complete that. So Roland asked, how do you invest in alternative assets? Do you do it directly or ETF? So of course, like directly, like no offense, but chances are you don't have that type of capital. We're talking about like tens of millions, hundreds of millions of dollars to go there. I know for experience that there are some mutual funds that are doing it, but then you have to be careful because the fees are crazy. In my days of working at private banking at National Bank, our portfolio managers had that part as well, typically looking at it as a kind of like a pension plan, but for you. But like Brookfield does that. But yeah, they charge a lot of fees. You have to be careful with that. So maybe trying to do a research on ETFs. But again, if you go there, the ETF price will fluctuate following the market, but really the investment behind it, it's a different ball game. So you have to make the difference in your mind between the value of the ETFs you just purchased and the actual value and cash flow ability, generating ability from this ETF, where the money is really invested throughout time, because they don't invest for the next quarter. They invest for the next like 40, 50 years.
And that's the thing. And I think it is a space you're going to pay higher fees. There's just more cost to running that type of investment. So I think then look at how much fluctuation there is. So an ETF mutual fund, like the underlying core asset, it's like when Apple price goes like this, like should it really, like the company really devalue by $1 billion or $1 trillion? Like no, of course not. But you're going to see some fluctuation there. But yeah, you're going to pay higher fees. But look at your net number. Like if you're still netting 8 to 12%, let's say on these alternative assets, like it's a good return. Even if you're paying 2% fees, it's just part of, like, even with BTV, they use the best of the best, like multi-billion-dollar portfolio managers to do their private alternative pool. I think the fees, like to the client, are quite low, but like internally within the fund, yeah, I think they're 1.5%. Like there's just more cost in that space. So
Yeah. And on the other side, I mean, if you have $1 million portfolio and you put like $150,000 there, it's just that portion that will be charged that 1.5% fees. not the entire $1 million. So it's not
Exactly.
the end of the world either. Sometimes it's worse to pay for fees, actually.
Yeah, for sure.
So moving on to the last mistake we wanted to tackle before we go to the Q&A, and I think it's like very timely topic. Investors about to retire going too conservative with their investments. Like too much fluctuation right now. Trump is going to crash the market. It's the end of the economy because the liberal won. Actually, funny thing is, it would have been the same thing if conservative would have won. Other people would go there. So we're not going to go into politics. It's always the end of the world somewhere anyways. Yeah. But for all those reasons, too many retirees are just like, yeah, I'm going in cash and in bonds and I'll call it a day.
And we saw that big time during COVID, right? Like 21, 22 especially. It's like, well, I can buy a GIC at 6%. Why would I ever invest in the market? Good point. Like you can get your 6% guaranteed, not very tax efficiently if you have non-registered, but their GICs are coming due and it's like, oh, 2.5, maybe I can get 3 somewhere if I lock in long enough. Like now we're barely keeping up with inflation, if at all. Like maybe not even at all at this point, right? So yeah, be careful not to scale back, and that's where I talk a lot about that cash wedge there, but this is where it matters, right? Like I think people think about, well, I don't want to take too much risk. It's like no. 3 years of cash flow, you have 0 risk, and statistically, if you do that, it does bulletproof. Like a lot of people want to see like the Monte Carlo simulations and sequence of return. These are all things you cannot control, right? So as you enter retirement, take control of what you can actually control, which is create a plan, know how much cash flow, and put the cash flow aside. You cannot, if you run a Monte Carlo simulator, it will show you a bunch of things and say, well, if the market drops 20% in the first year of retirement, here's how much is going to blow up your portfolio. Well, that's on paper, but if you actually create your cash flow side and let your portfolio come back, it actually doesn't affect you that much.
Yeah, you don't have to care that much about your portfolio if you can just withdraw from your cash account.
Yeah, we haven't we have about 200 and some odd households in our retirement income program. So these are people that do planning with us, investments with a third-party firm. We have not received one single call from any of them through this whole tariff thing because they know the process. They know we're not selling anything. In fact, there's been some rejig in the portfolio to take advantage of a situation like this. So, of course, we were proactive. We had webinars leading up. We knew stuff would happen. We didn't know what it would look like. I think everyone thought it would turn out a bit better than it actually did. But the point is, I think a lot of people do hit retirement. They scale back. Like, okay, had a good run. Let's scale way back. But run your plan at 3%. Does it work? If it does, then hey, then you can take no risk and buy that 3% GIC. But eventually, 3% might be a 2 or 1.5 GIC. Does your plan still work at that point? A lot of you are costing yourself retirement. Maybe not on this call, but Canadians as a whole are really hurting their retirement because they're just dumping everything into state because they can't handle the markets. Like markets make you money. It's what got you to this point in the first place.
Yeah, and I think there's also a strong voice in the medias and like your neighbors saying, oh, you should use kind of like rule of thumb of like your age, 100 minus your age, that's your like percentage in equity. And I'm like, yeah, but I mean, like you said, unless your plan can stomach it, but then you have to plan at 3%, it's going to be tough. And you can do so much more just having like that cash wedge and letting the rest keep on growing.
Like just quickly, if they buy like, let's say a balanced mutual fund, 60-40, right? So that's their plan. I'm going to de-risk by 60-40 mutual fund. I have a lot less exposure. Well, a lot of people, again, maybe not on this call, but generally Canadians, they're buying mutual funds or ETFs. And so when they need their cash flow, guess what? They're selling units of the ETF or mutual fund and they're selling equities, like good or bad. So it's like, you got to kind of rejig it a little bit different. So it's again, education around like, what is risk tolerance and capacity and what is this cash flow need I have? And I think a lot of retirees could be like a 90-10 portfolio and never get affected by the market.
Listeners, let's empower you in the investment world with our free dividend rockstar list, which includes stock ideas with positive dividend triangles. How does the list help investors, Mike?
Vero, we survey regularly our members and our readers, and we ask them what are their biggest struggle. And one that keeps coming back is really the buy struggle. Most investors don't know what to buy, they don't know when to buy it, and the Rockstar list will help them grow a little bit more their conviction because that list of stock will just include companies that show great financial metrics. Of course, you cannot start by picking them blindly, but it's a pretty good start to make sure that the company that you're about to read and know their business model is actually a business showing revenue growth, earnings growth, and dividend growth. The way I use it usually is I will filter it by sector to identify a sector that I want to have more exposure to. And then I just look for companies that have the strongest dividend growth model.
To download the list, enter your name and email at thedividendguyblog.com/rockstar. Again, hit pause now and go to thedividendguyblog.com/rockstar.
We had that discussion at Retirement Loop about like, what can you do? Because as I said, most people at Retirement Loop are DIY investor, but the double-edged sword there is, of course, your spouse is probably not as interested in managing the portfolio as yourself. And I had this exact same discussion with my wife. She just like, she wants to have like a yearly check of our finance. Besides that, she doesn't want to hear about it at all. So I'm thinking the day that I will not be able to manage my portfolio, or I will just not want to whatever, or give a plan to my wife, would be having that cash wedge and putting the rest into kind of like an all-in-one ETF, but mostly stocks. As you mentioned, if you go for an ETF or a mutual fund that is balanced or whatever, when you're selling a unit, you're selling 40% stocks still and then 60% bonds, but you're still selling some of your equity. So you have to consider this. Yes, it's going to be less volatile, but when you're selling, there's a part of it, you're selling those stocks price that are going down. So you have to consider this as well.
Exactly.
All right, so we do have a few questions, but right before we go to the Q&A, I just want to take a moment to thank you, Adam, for spending this hour with us. And also, maybe you can tell a bit more about what do you do exactly at Parallel Wealth? Like, do you manage money? I heard that you manage money, but you also do kind of like a fee-only plans. Like, how does that work? And how can you help people?
Yeah, so we don't manage money. We have investment
Okay.
firms that do that. Yeah. So yeah, we focus on fee for service or retirement planning specifically. We kind of have two buckets. I would say it's a bad term, but we have two buckets of clients essentially. We have consulting clients that come to us, they pay a set fee, and all of our fees and everything's on our website. But we charge a set fee, it's a consulting service. We grab your information, we map out a plan, go through it with you, give you the tools to move forward, but it's on you to implement. Whether that's if you're a DIY investor, at the bank, have an investment person, whatever it is. So it's more of a fee for service, pure retirement plan. We also have a large contingency of clients that come to us and say, I need the planning, but I'm not happy with my investment person, or a lot of DIYers that don't want to do it anymore. And they say, like, we kind of want everything. We want you guys or your team ongoing. And so that's where we have our retirement income program. So we stay in our lane. Like, we know what we do well, which is retirement planning, tax estate. We don't do investments. That's not our thing. So that's where we bring in a third party investment counsel firm to look after the asset. We do the planning and then work hand in hand with them. So if we build a plan, Mike, for you and your wife, and we say, this is what you need to do, we then communicate that to BCB. So they're not just managing your money and making sure it's doing what you need to do, but it's also aligning with kind of the cash wedge and cash flow planning within the plan. And then we update the plan. It's kind of an ongoing service. So those are the two, but yeah, we charge for planning in either way. One is an upfront fee. One is more of an ongoing because you're getting our team ongoing.
Yep.
But yeah, we have 8 CFP professionals on our team, and yeah, we stay in our lane and just do the retirement, tax estate planning of it all.
And I definitely think we need more people like you in Parallel Wealth, like people like focusing on doing that plan without having a second thoughts. Unfortunately, I mean, I've been in the business and yes, you're doing the plan, but what you really want is the investment. So when you're able to actually take care of the client the right way for a fee, so that's all fair, but it makes it even more interesting in terms of all the advice and the recommendation that you can put in the plan, because you know that it's not tied to a commission somewhere. It's really, well, you should do this because the math are saying that you should do this. And then it's up to everyone to decide how they apply those plans.
Yeah, we have a lot of people hire say, oh, I already have a plan from RBC, but I want to get it's like, well, what does it look like? Again, there's many things you can pick out, but typically it's, don't spend your money. Like, take CPP early. Don't spend your money because that's how they get paid. There's a conflict of interest. And a lot of people say, yeah, I'm interviewing a few, which I always say, like, interview many advisors, find the right fit. But it's, they'll do a plan for free, but they want my assets. Like, there's a conflict of interest there. So we try and remove ourselves from the conflict of interest. Even like BCB is a third party to us. We have other firms that we recommend as well. We're not tied to the investments. If they stop doing their thing, we'll get you out as a client and we'll find an alternative for you. So yeah, let's focus planning first, investment second. And that really is how it needs to be, especially in retirement. Like, we all have, if you're a T4 employee watching this and you're retired, you realize like you finally are in a world where you can do tax planning. T4 employees like RSP and donation. That's it. Now it's like, wow, I have all these moving parts. I can manipulate and manage it and make sure I pay less tax. You need to take advantage of that. And too many people don't, because it's like, well, my investment advisor told me to do this. And it's, yeah, I could go on for honestly days about this. So this is why we're in this space. And it's a US model. Like our business model is very much the IRA model down in the States, and it's planning first, investment second. In fact, most firms in the States just they planning, and it's like, yeah, we'll get you in this ETF or this or what, like, but that's like a side piece to it. We don't charge for that. It's more we charge for what you're getting value from, which is the planning piece.
Yeah, and I always like tell people the number one question in the interview when you interview like a financial planner or an advisor would be, how are you compensated? Like what's the structure? I don't need to know the numbers, but I need to know where you get the money from. And then you know where the advice is coming from.
Well, exactly, right. And I also say, like, another thing is, do they put their fees online?
Yeah.
It's like, yeah, we do planning. It's like, well, set up a call with us. It's like, no, just, but you're not. So yeah, anyway,
just be transparent, right?
Our industry is not transparent. So I think those that are like us, there's others out there, obviously. Put your fees, put a sample, put what you're going to get, what you're not going to get. Like that's what people are looking for.
Love it. I'm going to start with my question, and then we're going to start with the others, because I really want to hear you about this. What are your thoughts on those high income products, like the covered call ETF, anything that offers above like 10% and plus? I've been hitting on that nail for a while, but there's a lot of people that just, I don't know, having a hard time looking at the math. So I'm curious about your thought.
I think it can be an option for a percentage of your portfolio. I don't think it's an all-in, like the Adriano passive investing, all-in 100%. Like I'm not a fan of it personally to go 100%. I think there's some products, like we partner with Harvest ETFs on a few of our videos. I think they have some great products that fill a need for our client base, the retirees, a bit of cash flow, not the 15%, but more the 8 to 12%, where there's a bit of covered call. But again, I would say it's like 5 to maybe 25% of your portfolio max. Like understand what that product is. I think a lot of people jump into it because they yield, but they don't actually see how the underlying the cost. Like you're like, I don't want high cost, and then they buy covered call ETFs, and like you did zero research. You can guarantee zero research, because that is the most expensive product you can buy in the market. It's just all embedded. So yeah, I think I'm not against them. I'm not one that will say you should go 100% in your portfolio. And there's some good ones and there's some bad ones. And I think people just have to be careful that they do their research first. They understand what they're getting into, and also compare it. Like most of the covered call high yielding ETFs, if you compare it against a non-covered call option, they've underperformed. Yeah. So just
I mean, by design, it's built to underperform and to generate yield instead. So
exactly, right. And so as long as you know that, and that's why I say for retirees, it could be a party. I think for someone that's 30 years old, I'd say a bit of a red flag.
And I'd say like the biggest mistake is really to say, oh, I have like $500,000 and I'm going to invest all in into those products to generate $50,000, $60,000 in income, thinking you can actually retire with $60,000 income out of that $500,000 portfolio for the next 30 years. And this is where it hurts, because it's not going to work. But as you said, if you're going like 5-10% of your portfolio, kind of like a contribution to your cash with or something, and you're aware that there are fees, it's going to underperform the underlying assets. Now you make the decision knowing exactly what you're getting into, especially at retirement, because I've seen a lot of people on social media like saying, oh, but I'm reinvesting, I'm buying more units with the dividend. So it created like a snowballing effect. And I'm like, it's not really snowballing, because the price of that ETF is actually going down.
And some of your yield is your money coming back for you. So it's like you're getting your money back, your value of your units are going down, you're rebuying units. It's like, well, I'm reinvesting. It's like, it's just a circle that's spinning, right? So again, there's a place for some of those products. I like some of the products. I think they're very unique. They're different in the marketplace. A lot of people I talk to, similar to what you just said there, Mike, they haven't done their due diligence and research. They see, 15%. Of course, we all want 15% rate of return.
Of course.
Do your homework, spend some time, understand what you're investing. So, but no, I'm not against them. Like, not against them. It's not a 100% portfolio thing for me.
Yeah, I totally agree with you. Actually, back in 2012, I bought some, like the first covered call ETF started, and I was like, oh, that's super interesting. So I bought some, started to look at how it reacts versus the underlying assets. And I'm like, oh, okay, that's how it works. But yeah, you have to understand. That's really important. We're going to start with Sheila. She says, I just transferred an RSP to a different financial institution in March. just converted this RSP to a RIF and want to withdraw the minimum amount starting this June. To my surprise, the new financial institution has informed me that they will withhold tax even on the minimum RIF withdrawal amount, calling the withdrawal at a scheduled payment. Is this possible? Does it have to do with the fact that I convert it, or if I want to withdraw in the same year?
Yeah, so the year that you convert an RSP to a RIF, there's no minimum or free not free tax withholding, but there's no withholding tax. So yeah, you have to wait till next year, and that's why at the end of the year we always plan for clients. Okay, we need to start drawing money out next year. We want to convert before the end of the year to get that minimum, and especially for a LIF, a min and a max. So there's some planning ahead you want to do. Yeah, typically you don't want to see conversion from RSP to RIF in the first quarter of the year because you should have done that back in November, December. But yeah, they will withhold tax. You can't do anything. At the end of the day, yes, I know withholding tax not great, but for most Canadians, they don't plan ahead properly, so it's not bad that they withhold. Like you owe tax on that income anyway, so for them to withhold a little bit, maybe not a bad thing.
And on the other side, like just going a little bit outside of that, if you're tax, let's say you don't withhold tax on anything and you have a big tax bill and you pay it, chances are the government is going to say, yeah, you know what, this time you have like quarterly installment for the following years. Even if it was an exceptional year, now you're stuck with your own withholding tax plan. So on one hand or another, it's going to happen to you anyways.
Yeah, like I've been in this for 19 years, and I can say withholding tax is a good thing. Like people hate it. It's like, government has my money. It's like government's had your money for the last 40 years while you're working too. Have you ever seen the withholding tax on your paycheck? Like it's the same process. So
Exactly. Teresa, I just had a GIC expire at 4%. Exactly what we were saying, right? And the renewal rate now is 2%. Yeah, that's a bummer. Is there any downside to putting that cushion cash in something like cash.to at 3.85? So those ETF high yields accounts have been quite popular these days. We have like multiple of them. So what's the downside of like moving this from a GIC to our general, like just in general, like to an ETF savings account?
I mean, I'll take an ETF over a GIC all day because I use the National Bank NBIN 200, I think it is, something like that. So they have a Canadian and a US. And like your US right now, I think down there you're getting like close to 4% still. So yeah, I have no problem with the. I mean, Purpose has. It seems like every financial institution has one. So just find a decent one. Yeah, Purpose. I think Purpose, they have an F class, one that pays pretty good too. So again, lots out there. If I had the same rate of return on a GIC and an ETF, I'll take the ETF every day of the week.
Yeah, I would just add like the downside, if I can think of, is if we see Bank of Canada dropping the rates more, that account is also going to drop the rate accordingly. So because it's like short term. But of course, if you have the difference between a GIC at 2% and a cash account at nearly 4%, that's definitely a no-brainer. My argument would be if you have a chance between a GIC at 3% and a cash account at 3%, well, then you might want to think twice if the GIC guarantee you for like 3, 4, 5 years. But again, do you really want to lock in your money at 3% for 5 years? That's kind of like another discussion. But I would probably not go there either.
Even if it was a 1 year, my personal thing, like just with the rates, like sure, it might drop a little bit more. I would still have, I'd take the haircut on the flexibility versus locked. Again, if you know you don't need that money for a year, I'm the type, I've never bought a GIC in my life and I don't ever plan to. I don't like to lock my money into anything. I'd rather take a little bit less, but have the flexibility because something else comes up. Market, like what happens if you were in a 1 year GIC right now and you said, hey, well, if I had that in a high interest savings account, I could have actually deployed it in the market when the market dropped 20%. And like if you had that risk tolerance, right? So that's where I like the flexibility.
Yeah, and unless it's a cashable GIC, I can tell you from my banking experience, the only way to break a GIC is to die. So
Even
and I don't
that-
recommend that.
Even that, you lose your interest. I'm dealing with that right now.
true.
I have a client getting like $2 million, but they have to wait till December. Yeah.
But yeah, like long story short, flexibility go a long way.
Yeah.
Roland, I will retire this year. Well, congrats. And I have 8 accounts to withdraw from annually. That's a classic Canadian situation, definitely. If I want to implement a cash wedge, should I hold the minimum annual withdrawal twice in the cash of each account, like for 2 years in each account or 3 years, whatever, like the cash wedge you want? Should I hold that cash in a money market fund, like an ETF or funds, or as a high interest rate ETF? So money market versus ETF. And should I have this in all accounts?
So first off, let's take it a step higher and say consolidate. If you have multiple RSPs, like I mean, people say, yeah, I got an RSP at RBC and CIBC because I wanted to diversify. That's not diversification. That is complication. So if you're able to, now I get it, you might have just 8 accounts that are different, especially if you have liras with different jurisdictions and all that. I get that. So I would say consolidate as best you can. It's going to be nice when you retire too, because you're going to have less tax slips. Like if you have 8 accounts that you're taking from and they all are like registered, you're going to get a lot of tax slips. It gets very confusing. But let's say you have 8 liras and they're spread out and you can't consolidate anything. First off, the ETF, I would go high interest savings, like whatever is safe but giving you the highest rate of return at the end of the day.
Definitely.
As far as do you need the cash wedge in each one, you don't have to. You just wouldn't want to convert. Like let's say you have 2 RSPs at different institutions, or you keep them different for whatever reason. You don't want to convert both RSPs to RIF. If you do that, then yeah, you need to build the cash wedge in each because you have to draw money from each. But in theory, like I've come across some DIY investors like, well, I have 2 RSPs. One is longer term, one is shorter term. Perfect. Sounds good. Whatever you want to do. Then yeah, the one keeping an RSP longer term, you don't need the cash wedge, but you're going to need a bigger cash wedge in this other one. So it doesn't matter as long as in my RSP as a whole, I need to take out 50,000. If you have 4 RSPs, it could be out of one, it could be out of all four, 3, 2. It doesn't really matter. That's kind of the thing that you're doing as a DIY investor is figuring that out. So yeah, it doesn't need to be both. It could be one. Just make sure you don't convert all of them to a RIF and are required to take money out of all of them.
So kind of like a general rule, you need that cash wedge for each account that you will have to withdraw money from. So if there's an account you don't have to, you're golden. But all the others that you have to withdraw money from, you need that cash wedge. If not, you're going to be forced to sell at the timing that you may not like at one point throughout your retirement journey.
But consolidate. Like you shouldn't need eight accounts entering retirement unless you've moved across. Yeah, that
maybe Roland meant like TFSA non-registered spouse account, which that's why I said probably that out of those 8 accounts, maybe 3 accounts are going to be fit in your retirement plan income plan to withdrawals. All the others, like to your TFSA, chances are you're not going to touch it until you're forced to, and there's nothing else. So this one you can invest for forever.
Absolutely.
Last question, David. I have been reading mixed statements about converting RIF or LIF back into a RRSP or a LIRA. Can it be done? Well, we're going to start that and then we're going to go with the follow-up question.
Yeah, it can be done. Your financial institution will probably tell you no, but yes, it can be done.
It's just a lot of paperwork, right?
You will have to take out, it's a lot of paperwork. It's the same as converting the other way. You will have to take out your minimum for the year, though. So if you have a RIF and you want to convert back, you will be stuck.
You have to withdraw first and then you convert the rest. Okay. Sure. Follow-up question. If you can move between RSP and RIF several times, can you flip half of the RIF into RSP with each RSP to a RIF conversion? The goal of eventually melting down the RIF to less than 40% of the YMPE. At this point, can you empty the RIF into the RSP, thus emulating one account to manage?
Yeah, if you can move between RSPs and RIFs several times, can you flip half of the RIF into an RSP? Like for 99.9% of you, I'm going to say 100% of you. Like there's no need to convert to a RIF, start drawing it down there. The only time you're going to convert it back to an RSP and you do all of it would be, hey, I ended up getting a really good job. It's paying me. I don't need any of the RIF income anymore. And it's probably for a year, 2 or 3 or 5. Outside of that, there should be zero reason. There's zero benefit to swap. Like sounds like you're trying to create something that's not there, just reading that question. But yeah, there should be zero reason. Like build a plan. I'm drawing out of my RIF, convert your RSP to RIF, start drawing down. Typically, you're like this whole conversation around, the RIF minimum should be changed. And for majority of you should be converting long before 71 and taking out way more than the minimum. There's the odd, exclusion up to that, but for most of you, like each 71 conversion and the RIF minimum should play no factor in your plan.
Yeah, and I've seen it exactly the same thing that you've discussed across all the plans. Most cases, you should start withdrawing money from your RSPs, convert them into a RIF way before 71. It's really rare that you have the opposite plan. But again, depending on the situation, you can always say it's like an official rule. But as a guideline, I would say run the simulation on both sides if you don't believe us, and you'll see right away the impact is there. I mean, you just run the math at this point. All right. So Adam, again, thank you so much for being with us today. The full replay will be at Retirement Loop as well. So everybody will see the Q&A and everything. I had a lot of fun. If people want to reach out to you, you do have your YouTube channel, Parallel Wealth. And if
Yep.
not, I also put that in the chat, parallelwealth.com for financial planning, fee only planner, non-biased advice. That's pretty cool. So
Yep.
wish there were more of you out there. So
We're
good
trying.
job.
Thank you. Well, it's been fun. Thanks for having me on, and we'll do it again another time for sure.
Sounds good. All right. Take good care now.
Yeah.
Bye.
Bye-bye.
So that's it, listeners. I hope you enjoyed this two-part podcast episode on 5 retirement lessons for your retirement plan. Thank you again so much to Adam and Mike for helping us retire stress-free. To learn more about Adam, visit his YouTube channel at Parallel Wealth or our show notes at thedividendguyblog.com/228. Next week, we will receive another guest, Ryan Williams. I literally got a professional crush on the guy, so hit the subscribe button now not to miss it. And until then, stay invested.
Stay invested.
Hey fellow investors, it's Mike here. I hope that you have enjoyed this episode. Please note that the Dividend Guy Blog podcast is at no time issuing buy or sell recommendation. Please do your own due diligence as this podcast is recorded for information and hopefully fun purposes only. Make your research, make sure you do your stuff. We're not responsible for your losses or your profit after listening to this episode. And until next one, stay invested.